having its own big week. Christina Partsinevelos joins us now with more on that move, which has been pretty good in its own way, right?
Yeah, because Nvidia shares are finally breaking out of their 2025 slump after climbing, more than 5% this week, and it was pretty much trading flat all year since January. The stock had been held back, though, for two main reasons. Number one, potentially tighter export controls under the Trump administration following DeepSeek's recent breakthrough. That's when you really saw the stock drop in mid-January. And production challenges. That's point number two with Nvidia's next-generation Blackwell chips. These supply chain worries led Mizuho analysts, for example, to project just in-line results for Nvidia's upcoming January quarter. That's going to be, we'll get some more details on February 26th. But the outlook is improving. HP Enterprise has now shipped its first Blackwell-based product, while AI server maker Supermicro is forecasting surging demand for 2026, a strong signal for future Nvidia chip sales. Meanwhile, Nvidia's investment arm has been reshuffling its portfolio. The company's latest filings show it did indeed cut its stake in ARM Holdings by 44% to 1.1 million shares and completely exited positions in NanoX Imaging, Serve Robotics, and SoundHound. SoundHound shares actually falling about 29% today on that news. But Nvidia is also placing new bets, acquiring 1.7 million shares in self-driving tech company WeRide, which has soared today over 80%, that's share price, and then also taking a $1.2 million share position in AI infrastructure firm Nebius Group. That shares stock is also up about 5%. Keep in mind, these are Q4 numbers, not reflecting Nvidia's investments in 2025. Scott.
All right.
The robo-taxi firm operates a range of autonomous vehicles like robo-vans, robo-road sweepers as well across 7 countries. It's launching a pilot in Switzerland and a partnership with Uber to offer robo-taxis in Abu Dhabi. Nvidia is no stranger to this industry, providing AI computing infrastructure for driverless cars. Its Drive platform, that's the name of it, helps robo-taxis process sensor data in real time. As for Nvidia's other investments, the 13F reveals Nvidia still owns stakes in Applied Digital as well as Recursion Pharmaceuticals as of the filing date, which we know doesn't reflect investments in current time 2025, but it's helping all of those names move.
Recently, Nvidia's stock has been declining. Shares of the well-known chipmaker were down less than 1% as of Tuesday's trading, putting them in negative territory for the year. Even though it's early in the year, the deceleration is significant for a stock that had gains of 171% in 2024. With a market price of over $3.3 trillion, it is still among the most valuable firms in the world. But there is a chance that Nvidia could still be a fantastic investment, and according to one measure, it might even be a great bargain at the moment. The price-to-earnings, PE ratio, is a multiple that investors frequently use to assess the worth of firms. On a per-share basis, that indicates how costly a stock is in comparison to its profitability. However, PE multiples can change depending on the industry a company is in and the amount of growth it is producing. Although Nvidia's PE multiple of over 50 may appear excessive, it might be justified if you anticipate significant future development from the company. A multiple like the price-earnings-to-growth ratio, or PEG, is useful in this situation. Analyst forecasts for future growth are taken into account. Based on anticipated growth, a PEG ratio of 1 or below is typically a sign that the company is a strong investment. Given the current prognosis from analysts, Nvidia's PEG ratio, which is based on its projected growth rate for the next 5 years, is currently at 0.96, indicating that it is a good deal. Does this imply that a significant rally in Nvidia's stock is imminent? One could be tempted to believe that Nvidia still has a lot more potential given its low PEG multiple, and in the long run it might. However, the analyst forecasts used to calculate the PEG ratio are subject to vary over time. Furthermore, given the mounting concerns about whether tech corporations are over-investing in artificial intelligence, AI, adjustments may be imminent. Due to the introduction of the DeepSeek AI model, which is reportedly just as successful as ChatGPT but much less expensive, investors seem to be becoming more concerned about tech investment. Investors might be questioning whether all those Nvidia processors are actually required for AI development if that is the case. One of the main causes of investors' continued optimism has been Nvidia's explosive expansion in recent years. Additionally, a slowdown can have an effect on the stock and even lead to a sell-off. When Nvidia releases its earnings later this month, investors will have a better understanding of the level of demand, which may ultimately determine how popular it is to buy the stock in the coming weeks. One of the industry leaders in technology, Nvidia is a wise investment to purchase and hold. With $113 billion in sales during the last 12 months, it has made over $63 billion in profit. The company has a lot of freedom to cut prices or utilize the earnings to invest in new growth prospects because they are excellent margins. Because the company has the financial capacity to adjust to shifting market conditions, the stock may remain in fantastic form over the long term, even if tech expenditure slows down. Given that Nvidia's stock has come to be associated with advancements in AI, there might be volatility in the coming year or two if the enthusiasm for the technology wanes. It might still be possible to invest in this top tech stock at this time, though, if you're prepared to wait a few years and possibly weather the short-term volatility. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
Personally, I was just listening to this whole report, but I'm perhaps most curious about the Parts Nevertheless investment because it sounded like there was a baby behind you, and I'm all for that. But if I stick with this,
there's a baby right next to me.
Love it. But if I stick with Nvidia, I am just curious because as we see companies like Nvidia get bigger and bigger, the ability to do more and more M&A, at least in the past couple of years, has been perhaps stifled. And so I wonder if we continue to see more of these types of investments, these types of strategic partnerships, et cetera, from companies that are flush with cash above and beyond Silicon Valley and above and beyond hedge funds.
You could say definitely that's the case for Nvidia and its shareholders, and I say that because the stock and share price has been range-bound for quite some time. Around the 200-day moving average of $125 to just passing the 50-day moving average of $135. I bring that up because investors want more. So when you have the ARM investing in various companies like the WeRide, for example, it shows that Nvidia is putting its money to work and possibly in future M&A activity, which would bring back some return to shareholders, because right now it really takes a lot to impress Nvidia's shareholders. The stock's up dramatically over the last year, but year to date pretty flat.
As of this video, shares of the semiconductor giant Nvidia are down almost 3%, contributing to the company's forgettable start to 2025. A number of uncontrollable variables have also contributed to the decrease. For example, the recent announcement of the Stargate project, which could see $500 billion invested in artificial intelligence, AI infrastructure in the United States, somewhat lessened the impact of the extensive restrictions that the previous Biden administration had proposed on the sale of Nvidia's chips to overseas consumers. Nvidia's stock rose as a result of this development, but the chip creator would soon face another sell-off. Chinese AI startup. When DeepSeek published their R1 reasoning model, it stated that it had only cost a meager $5.6 million to train. The O1 reasoning model from OpenAI, a business that has been investing billions to develop its AI infrastructure using Nvidia chips, proved competitive with DeepSeek's model. Thus, the Chinese company's model's efficiency and low cost caused Nvidia's stock to plummet. Investors were concerned about a possible decline in demand for its graphics cards, which are utilized by governments and large cloud computing corporations for AI inference and training. After DeepSeek's alleged breakthrough on January 27th, the semiconductor giant lost about $600 billion of its market capitalization in a single day. But according to a report by SemiAnalysis, an analytical firm that focuses on the semiconductor business, as reported by Tom's Hardware, DeepSeek might not have disclosed the true cost of training its AI model. DeepSeek reportedly spent $1.6 billion on hardware, according to SemiAnalysis. Additionally, it states that the Chinese startup has access to 50,000 Hopper graphics processing units, GPUs, from Nvidia's previous generation, 10,000 of which are the company's flagship H100 chip. SemiAnalysis goes on to note that the $6 million amount that DeepSeek has highlighted simply represents the possible expenditure for model training. Other expenses related to research, data processing, model refinement, and infrastructure costs are not taken into account. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now let's dive into today's video.
AI chip giant Nvidia versus ARM Holdings. ARM makes the blueprints for Nvidia and other semiconductor companies' chips. An SEC filing shows Nvidia sold about 900,000 of its 1.9 million share position it had in ARM. No comment on why Nvidia sold the shares, but ARM is smarting from the move. We've got Nvidia up 2%, ARM off the lows of the session, but still down about 4.5%. Arguably, on any other day, ARM might be jumping on this headline. The FT reports ARM will actually start making real chips, not just the blueprints of chips, as early as this summer. And its first customer will be Meta. Meta on pace for its 17th straight record close. It's really historic here, folks, and its 20th day.
Since DeepSeek has its own data centers and has apparently spent over $500 million on AI financing since its founding in 2023, it is likely that the cost of training the R1 model that caused Nvidia's stock to plummet was higher than what the Chinese business is claiming. Investors may have pressed the panic button for the wrong reason if that is the case. The good news is that investors now have a chance to purchase this rapidly expanding company at a discount due to Nvidia's weak start to the year. That might out to be a wise decision for the following 3 reasons. Nvidia's valuation is the primary justification for purchasing it. Investors and experts have been concerned about the stock's high valuation after its spectacular climb over the last 2 years. It is currently trading at some very alluring levels, though. Nvidia's projected earnings multiple of 30 is lower than the tech-heavy Nasdaq 100 index's 33.4, despite the fact that its trailing price-to-earnings (PE) ratio of 51 is higher. DeepSeek is the second reason why investors ought to think about purchasing Nvidia. An increase in the demand for AI applications may result if DeepSeek's claims are accurate, and it has successfully created a low-cost model. In 1865, British economist William Stanley Jevons noted that the demand for coal would not decrease despite more efficient coal utilization. Rather, it would encourage more industries to use coal. There are numerous other uses for this idea, which is called the Jevons paradox. For example, the introduction of inexpensive LED bulbs hasn't necessarily resulted in lower electricity bills, because consumers have opted to install more lights due to the lower costs, but the increased fuel efficiency of cars has apparently increased the distance driven. As a result, the demand for Nvidia's chips is expected to continue to grow as a result of more effective AI models. As a result, Nvidia may benefit from DeepSeek's alleged innovation. The fact that cloud computing behemoths will continue to invest more in AI infrastructure is the last justification for purchasing Nvidia stock after its recent decline. More chips will be needed for President Donald Trump's $500 billion AI infrastructure initiative, which is being spearheaded by companies like Oracle, OpenAI, SoftBank, and Abu Dhabi-based AI investment company MGX to construct AI data centers. A robust market for AI chips is also shown by recent statements made by the CEOs of Microsoft and Meta platforms endorsing increased investment in AI. Lastly, an increase in reservations for the cutting-edge machines offered by the massive Dutch semiconductor equipment company ASML shows that there is still a need for sophisticated chips to handle AI tasks. Given the strong growth that Nvidia can produce in the long run, investors should take advantage of the current downturn in this AI stock. As a result, it won't be shocking to see the company's fortunes turn around. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.